I loved your note on the Fed. At a consensus, you see the first hike coming in September and only 2 this year. Why?
Yeah, so we're not necessarily out of consensus on the number of rate hikes we expect 2 this year, but the timing is quite out of consensus. If I'm looking at the world through a monetary policy lens, and I know that I've undershot my price stability goal of 2% for 8 straight years, I want to allow inflationary pressures to build, not let the economy run hot. Let's not get Yellen's feathers ruffled on that comment, but allow inflationary pressures to build and fiscal policy to take hold. You talk to monetary policymakers and many of them say, we don't even know what's going to happen with fiscal policy yet this year. So we're not going to build that into our forecasts. About half have, about half have not built fiscal policy into their forecasts. And so I want a little more certainty, a clearer lens on what the economy will look like in the second half before moving.
Yet last week, though, it seemed like the takeaway from Fed Chair Yellen's testimony to Congress was hawkish, that the bar wasn't really high for inflation to move higher, and the same for unemployment. Why was your takeaway more on the dovish side?
Well, I think it's more that policymakers are more optimistic, and Janet Yellen is as well. She might not have built in fiscal policy assumptions into her forecast, but clearly she is more emboldened by what could be delivered in terms of how confident she feels about the outlook. And she said more gradual increases in the federal funds rate are likely warranted, and we couldn't agree more. Right? We're going to double down on the pace of rate hikes this year, 2 instead of 1 in each of the past 2 years. Now, I know you're smiling. I know that sounds funny to say. We're going to double the pace to 2.
Yeah.
But, you know, I think it's right for them to be more optimistic about the outlook. We're just arguing that the timing, this is still a Fed that should remain a little cautious and let inflationary pressures build first. I think in the first half of this year, it's going to be tough to get core PCE prices up a lot because we've got some very tough year-on-year comps coming, and we still have previous increases in the dollar that have yet to come through. So we're betting that inflation isn't going to rise at the core level, core PCE, as quickly as they'd like it to.
That's probably an accurate description of the Fed Chair's view of the world. I just wonder whether the Fed Chair still leads this committee or whether the committee is going to lead Chair Yellen throughout 2017. Has she still got a handle on this committee?
Well, that's a big question. Right? I think she has a pretty strong following in the core of the committee. She's not on the most dovish side of the committee. You've still got Brainerd carrying that flag. But I think that she can still hold together the troops and hold them together. The big question in clients' minds is this going to matter much if Donald Trump fills those empty spots on the Fed board? You know, I don't think that influences her, as some might think that, well, let's go ahead and get rate hikes in now, or do my policy now that I want to do now because I don't know what the face of the Fed is going to look like later this year. I really don't think that plays into prudent monetary policy making, and she is very prudent. Some of my clients say, well, they're not going to move in March, but June, they don't want to do it around the French election, so they're going to go in May. If you're a monetary policy maker, you don't just go in May because some disaster may happen in Europe after that. You don't then front load your rate hikes because of that. So I don't think that's the way they'll think as well.